and we're here giving you guys an update on where our Market Minder program is at. Cody had left. Aaron has come on board with us. He's going to be helping us trade the Market Minder. He's already kind of immersed in the bean side of things here the last 8 or 9 months and doing a lot of the bean trading with us. And but yeah, since Cody left, we're going to get Aaron on the screen here and get him some air time and get his opinion on what the markets are. Aaron, you got anything here to add to us? And introduce yourself a little bit here.
Yeah, just want to introduce myself. I'm Aaron Maher. Grew up in Burnfield, Illinois, on a row crop farm of corn and beans. I worked with Rumbling Coon for 6 years and have been on with Rural Rally going on year 3 now. And kind of stepping into the OTC space along with helping Matt out with Market Minder now. So just kind of, and I also buy grain there at the Valley location and help out with merchandising.
We appreciate having you on here today, and we appreciate your feedback and help with the Market Minder product. First of all, I'm gonna kind of get into like how we've traded the Market Minder on corn, and then kind of let you try and explain how we traded the soybeans. First of all, we started in corn in January. We got up to about 20% sold when we got up above that 470 level right away. We thought that was a good start. We figured we'd have a lot of acres. We had the market had rallied off that negative January report, we got 20% sold right before the January report, up in that 470 level. The market kind of set back at that point in time, and then we had the invasion of Iran. You had the carryout keep getting smaller, and that market kind of went up into that $4.80 to $5 range, and we kept scaling into sales as we were up there. When we were there during that time frame, we also put on some options positions that protected the downside. Still felt there was a possibility of having a large crop. You didn't see that. We knew that there was going to be a lot of old crop sitting around, and we wanted to make sure that we were really well protected to the downside at that point in time. June came along and the market sold off, and it sold off really, really hard in the month of June. At that point in time, we felt like the market had sold off too much. And what we had done is those option positions that we had put on, we kind of liquidated those option positions and bought back just a small chunk of the program to go long some more bushels on what we had sold previously. The market then rallied in July on the back of some worse weather. We got a little bit hot and dry. The market got a little bit nervous about the crop size. In some areas, that market rallied back up into that 480 to 490 type of area. At that point in time, we sold back that small long that we had bought back. And then we also put on a little bit more options to protect some downside when we were up in that area. Here yesterday, we actually bought back those options. We actually added a little bit of some long via some call options and stuff like that here before the report also. And today we're sitting at about 50.4% sold. Our average price that we have sold at today is about 487. And currently waiting for some more higher levels to sell some more at. So current average sale price right now is 488 3/4 roughly on 50.3% of the bushels. Our current market value of the contract, that means if you take where we've sold at with the current futures price, we're at 484 or 485 on the contract. And our current futures price today, as of this morning, was $4.81. Now that's just a little bit lower here as we've opened, but we were 481 at the close last night. So that's how we try to traded the corn contract. Can you give us a little bit of details on how we traded the beans?
Yeah, absolutely. Between you, Cody, and a little bit of me, I guess, starting there in January, you guys really scaled up the sales and got aggressive. ahead of the South American harvest between that $11 range and 11.30 price level throughout the month of January, and kind of going into February. We utilized some option strategies to protect the market from a large setback, knowing that we were at one of the highest levels in beans in the last couple of years. So you want to kind of take advantage of it. Going into April and May, we kind of continued making sales. Only got above that 11.60 to $12 range. And kind of going through June, July timeframe, usually when we kind of hit the seasonal highs of the market, we priced another 20% in that $12 to $12.50 range as we scaled up higher in price. And now currently the book stands as we're roughly 74% sold at a price of 11.35 and a half. And if we were to sell out today, the value of the overall contract would be 11.44.
Yeah, and I think
And my current
go ahead.
yeah, I guess going back to this side, given a little bit of bias on the beans after yesterday's report, I think a bean stayed choppy with a kind of slight bullish bias. No futures are trading around that 11.80 price range, and we did make a nice bounce on the lows post report. Despite the larger crop, we do have a record crush demand and a renewed Chinese buying, which is pretty supportive in my opinion. So we'll just kind of stay tuned and kind of see how this next couple months trade.
I agree with you. And I kind of just want to defend like what we did there when that market was in that 11 to 11.30 range. You know, we were just coming off a harvest where a lot of guys were pricing $9.50 to $10 beans, you know, in the fall there for September and October. And when we crossed above that $11, we felt we needed to get, you know, relatively aggressive there because that was sitting at like almost a 2-year high in the market, you know, as we crossed above that $11. So we did get jumped on that level, you know, on and one because it was the highest price we'd seen in 18 to 24 months, and then also because South America had an extremely good crop on their hands, what it looked like at the time, and they were priced $1 to $1.50 cheaper than us on the world market, and you know, we felt that we could have seen a really big setback at that point in time if the market were to follow like where the crop the values of the South America crop was, and we ended up not, you know, following those values, right, because of the Iran war. Those actually the values of the South America crop kind of rallied up to where the U.S. values were, and our bias, you know, on getting that aggressive was a little bit, we missed out on the higher end of the market, you know, later in the season by getting aggressive early. But the reasons why we did aggressive, we had good reasons to try and get aggressive in that market. Why don't you give me a little bit of insight on what we had a USDA report yesterday. What is a little bit of the insight on what are some of the bullet points that we went through with the USDA point?
Yeah. Looking at yesterday's kind of USDA, the WASDE report, definitely gave us a more supportive outlook on corn. The USDA lowered the yield to 180.7 bushels per acre, which was kind of historical in my opinion. I didn't think they'd walk it back that much from the previous report. And they cut projected new crop ending stocks from 1.79 billion bushels last month to 1.65 billion. So that's very supportive as well, meaning that we had a stronger export demand, and that's also kind of helped tighten the balance sheet. Kind of going over some kind of on the charts here, I could see maybe a trading range from on old crop roughly from 450 to 470 for the time being. Now we might see a little harvest pressure that could still limit rallies, but I think the tire supply outlook should provide a better support in the long run.
Yeah, I thought what was interesting is, you know, they did increase the acres, you know, which I think was a surprise. I think I kind of bullet pointed, you know, our demand numbers and our acre numbers that could throw us some surprises in this, and it did. The acre numbers went up 1.4 million bushels or 1.4 million acres on both corn and beans. Our yield dropped significantly, which really, the funny part about that report is we actually went up on production 13 million bushels versus the July report. Even though we went down on yield, the acre increase offset any of that. I thought the big thing is the demand. We penciled in 75 million more bushels of old crop exports and 75 million bushels of new crop exports. So it just goes to show like how good that demand base is. You know, I think there's very good potential to have that demand even increase further down the road, especially on the export side. And you know, I think that's the positive of why maybe you're a little bit bullish here, not necessarily, you know, the huge, I mean, you're going to grow 16 billion bushels, they say, at these numbers, which is still the second biggest crop ever. However, our demand base is extremely strong. We're losing bushels, and we're declining the carryout in the second largest crop we've ever grown. You know, and I think that demand base is extremely impressive. And that's why I'm probably a little bit more friendly on the corn side here, is because of that demand base we have. And USDA kind of confirmed that yesterday in their report. Bullish factors today. Again, talked about that demand base, that strong domestic demand. European weather has been terrible. That's going to shift some additional demand, some corn. They're going to have to import some corn, some wheat with the Black Sea uncertainty over there with Russia and Ukraine. You don't know how much they're going to be able to get from those places. So that should increase demand coming from us. You know, we should be able to export some corn over to Europe here this year. We're going to stay strong into Asia markets because it's just going to be hard to get, you know, feed stocks out of that Ukraine and Black Sea region. And there's just a lot less of it this year. And that just people have to come to us or Brazil or Argentina to find it. And you know, that's going to be a very good base for us for demand. Chinese demand remains potential for corn. That could definitely be another upside catalyst if they are going to, you know, fulfill $17 billion worth of ag trade that isn't soybean related. They're going to have to buy some corn from us, I feel. And then the USDA lowering those projected ending stocks to 1.6, you know, this early in the yield or this early in the year because of that yield decline. I think that tightens up the balance sheet, you know, that at some point in time, you know, if we keep demand based high, you might have to ration some of that demand a little bit. And with everybody kind of making money on corn here today, you know, where do you ration demand at will be a big question. But a little bit of some of the bearish factors today, Aaron. What do we got to watch out for?
We kind of have to watch out. We obviously have an ample old crop corn supply heading into harvest. We're not really at that kind of bullish 1.5 carry out number. That's kind of my bias. If we get below 1.5, that's when we really start looking on the bullish side of things. So that's a little bit bearish. The weather looks really fantastic right now. I mean, we've definitely had some windstorms this last couple of weeks. That hasn't been helpful, but we just get an ample amount of rain. And I think that'll help really finish out here the month of August for both corn and beans. Brazil's safrinha crop still remains large, and Argentina is very competitively priced compared to us. The fund length in corn, I guess on the technical side, and soybeans could trigger liquidations if sediment returns. Chinese, they have been buying consistently, but is that going to run out here at any point in time? You never know with trade tensions with the current geopolitical situation. And lastly, kind of USDA raised the projected 26-27 bean netting stocks to 320 million bushels in yesterday's report compared to 310 million bushels from the previous report. So that is somewhat bearish, and we'll just have to find a home for it here in the future.
Yeah, so I mean, I definitely think I think we got to be cautiously bullish, right? I think both you and I are kind of lean toward the bullish side here on from a corn standpoint, and I am probably a bean standpoint. But we still got a lot of things in the market that can happen, right? There's still some spots there's going to be plenty of old crop corn to get through. There's plenty of corn at harvest to get through, right? So this thing doesn't need to go straight line up, I think is what we're warning producers, right? And the more you kind of stay out there, we've had a lot tighter balance sheets and a lot other areas that I can remember and that I've traded corn or been in this business that you've thought, man, this thing should go to the moon, right? Should go a lot higher than where it is today. And you lose, you go down 30, 40 cents because of something, right? There's just something else that comes into the market that you don't expect and the market goes down. So, I'm going to caution us that there still are bearish factors out there, right? It's not all bullish. Everybody wants to be, it feels like a little bit bullish today. And I'm that way also, but be cautious that there is some bearish factors out there still. From a technical standpoint, this is just a chart going back to from basically in the summer of 23, or the spring of 23. And just this line here, this year we've had a high of 506. We've had a low of 439 on that December contract. I think a key area is 470. As we get below there, we've had resistance to get above there, and as we've gotten above there, we've had support at that level. Both times we've been above it and below it. So I think that's a key area of support and resistance here on the corn chart. We have not closed above 496 on a weekly chart in the last some years, going back to August of 2023. So I think that would lead, if we got to a weekly chart and we closed above 496, could we see some follow-up buying and the market kind of rally off that? Could that be a sign of some higher prices to come that are maybe above where our range has been so far? So that is something I would look for as a weekly close above that 496 level, which I think would open that up to some more a higher level of corn potentially, maybe a run back up to that high fives or mid fives to high fives type of level.
Yeah, just to add to that, if we break above our high of 506, I guess what's the next level? Do we go to 520, 525? I mean, I think it's kind of wide open if we can start ratcheting higher.
You bet. I kind of tend to agree. Where do we go from here, Aaron?
Oh, just looking at yesterday's report, just to kind of recap, they did lower the yield from 183 to 187 or 180.7 bushel per acre. They did add overall acreage, so that kind of offset a little bit. But we have a stronger exports, which definitely provides more of a supportive outlook. And like I said before, old crop, cash corn, I think we're going to keep trading between that 450 to 470 range. New crop, like I said, if we ratchet higher about that 496 close, that could open up the door going past 510 on the futures market. On the bean side, I think we're going to stay choppy with a slight bullish bias. We're trading around that 1180 range, and I think if we have a close above 12, that could potentially open up the door to 1225 to 1250, kind of like our previous highs. And if we do break below our previous low of 1160, right in that range, I mean, we could easily go back to that 1120 to 1140 range. So I think we need to be cautious, and we don't really need to take this lightly and stay aggressive with it.
Yeah, I like that 1160 to $12 range here while beans look as good as they do, I think, in the field. And I think it'll be hard to break above that $12 range psychologically. I think that's a good, I think that's a good trading range. And if we did get above there, I think that does open the door up for some more, bushels. But with them raising that ending stocks yesterday, with the big question mark of Chinese demand, world stocks on beans is still high, higher than it's been. So I'm cautiously friendly beans for those reasons. And then, I think yesterday I'm probably a little more bullish corn than I am beans. The market has established a really solid price in floor, in my opinion, with them lowering that yield, with them taking that carry out down to 165. I think we can really trade in that 460 to 510 range a lot of this fall. I think our downside, is fairly limited. It's going to be hard to get D corn below 460, in my opinion. And because when you get that below 460, you're just not gonna, we need so much demand. There's just, the farmer's gonna kind of shut the door and quit selling, and you're gonna have to kind of rally that price up in order to get him to move bushels. We'll need to still navigate old crop selling pressure in the early stage of harvest before maybe reaching the higher end of that. But yeah, I want to keep locking in profitable levels this fall as we see rallies and see bounces, as we see, that market get up to, that 490 area to 505 type of area, be locking in those type of levels, and then maybe look to keep your upside open via some call options or some sort of strategy for post-harvest opportunities that might come down the road. Speaking of that, what do you think are some good ideas for producers to pay attention to here this fall?
Especially while we go into harvest, figure out your cash needs. Kind of to start with, what you can, if you have farm storage, what you can fit in the bin, what you have to sell off and bring either straight to the market or bring it here to the elevator, and maybe get that locked in and consider a call strategy to maintain upside into March or May, kind of going out into the back months in case we do see a rally kind of post harvest. Kind of on the OTC side of things, evaluate your accumulator contracts that you have on. And if we do exceed the highs of 506 on the DC board, maybe kind of look at kind of where March is trading at and maybe kind of scale into a few more accumulators. We definitely don't want to sell it all at once, and kind of, you want to keep the upside open and be cautious of double ups. Definitely use contracts that provide a floor while preserving upside opportunity. Maybe kind of step into a put call spread, that kind of structure, and definitely capture the market carry when selling bushels to kind of improve our cash flow and net price. Kind of going out, looking at the spreads in the further months, we have plenty of carry right now, but that's not guaranteed, especially if we have a short crop going forward. Those could definitely firm up and we could lose that carry pretty quick. And then
Yeah, and if you're a bullish person, right? Like, and I know most farmers get into a bullish mindset where hey, the market is bullish. I have reasons that the market are going to go higher. We tend to focus on those reasons why it's going to go higher, and it makes it hard to sell bushels, right? But I would strongly encourage guys, right, to make sure the last 2.5 years, 2 years, we've struggled to be profitable. As we get to some levels that allow you to make good money in row crop farming, make sure we take advantage of those with floors and leaving our upside open, and sell the profitability. Don't speculate on the market, because if we're going to speculate on the market, we're not apt to do that very well in the positions we're sitting in as farmers. So I would challenge guys, lock in. You're looking for profitability levels. You're not looking to hit the highs of the market. Tighter supply outlook. The market's shifting away from an oversupply situation like we've had the last couple years to a tighter carryout, which may require some demand rationing and increased acres, right? That eventually leads to higher prices, we hope, right? And the market rallies. But where those price peaks are going to happen and where, people are going to get sick of buying corn, where fund money liquidates is really kind of an uncertain thing. So again, continue pricing profitable opportunities and utilize risk management strategies from guys you trust, right? From people that have good ideas that are able to put your bottom line in the back of their head and do good strategies, have good strategies that take advantage of managing risk.
And if you're profitable at the current level, why not take some risk off the table and lock in some sales? That'd be really good risk management.
You bet. Must flow bushels, I like the accumulator ideas, right? If we can get, the old highs potentially could be hard to break through. Potentially. We don't know, but the old highs could be hard to break through. So if we get the opportunity to put some accumulators on, you're undersold, and you're able to put some accumulators on above those old highs, I would maybe look at doing that too. Those aren't bad risk strategies to price higher than where the high's been of the market so far, if you're in a position where you're undersold in the market. Lastly, I just want to thank everybody for tuning in, if you've tuned in this long, right? But I appreciate you guys entrusting those bushels with us in Market Minder. We do not take that responsibility lightly. And it is our focus into helping that farmer capture the best price we can with that program. I'm a very competitive person, and I want to have the best price available that I can for farmers. And I appreciate you guys allowing us to trade those bushels for you.
Yes, we appreciate your business.
Lastly, if anybody has any questions, has any side notes, has any questions on how we're trading, please reach out to Aaron or myself. Our numbers are here up on the screen. Reach out to who your originator is, and hopefully we can help answer some of the questions if you have further questions. But appreciate the business, and we'll let you get back to your day. Thank you.
Yep. Thank you.